Welcome to the Attract Capital webinar series. Today, I'm your host, Jack, and I'm here with Attract Capital CEO and founder, David Barnett.
Hi, everybody.
Today's webinar is about the $1 million equity question of your leveraged buyout. So let's get right into this. Dave, what is the $1 million equity question of your leveraged buyout?
That's a great question, Jack. And this topic refers to how much money an independent sponsor has to put in their deal in order to get it closed. And we call it the $1 million question because we get a lot of phone calls from a lot of independent sponsors, and they're all trying to figure out and triangulate how much money that they have to put in the deal in order to get a lender to provide the rest of the financing. And it's actually a very critical question for an independent sponsor to think about. And often they want to put in very little money, and they don't appreciate how important, how central this equity investment issue is to the lender. So it's a very important subject, and it makes or breaks a lot of deals, Jack.
And how important is the level of equity invested in the investment to the lender?
Well, it's extremely important. It's central to the lender's decision. Obviously, they're going to look at the historical profitability. They're going to look at the balance sheet strength. They're going to look at the industry and the character of the sponsor. But it's extremely important because these lenders that do leverage buyout lending, they only back serious, experienced, independent sponsors. They need to see skin in the game. They need to see capital at risk from these independent sponsors in order for them to have the comfort to make the loan. And a lot of their reasoning for this, it makes sense because leverage buyout lending is a risky endeavor on the part of the lender. Lenders are lending at high multiples, and so they need to see the equity support to de-risk the capital stack for the overall transaction. And they also want to make sure that not only that they can put equity into the deal up front, but that there's an additional capacity that the independent sponsor has to put in more capital down the road if there's a need for it.
And for these independent sponsors, what's a good guideline for equity investment in a transaction?
So Jack, every deal is different, and there's no one-size-fits-all solution here, but they absolutely need to contribute cash equity to the deal. A lot of these independent sponsors try to leverage the seller note or residual equity that the seller might keep into the deal and say, well, the seller's keeping all that in there and I don't have to put in any cash. That is a losing approach. Lenders don't go for that. You need to have capital at risk. And so what we tell our clients, and really we've only been dealing with our businesses based on independent sponsors, we tell them that they need to have between 30 and 35% total equity in the form of cash equity and seller note or residual rollover equity. It can be 15% cash equity and it can be 20% seller note, but it has to appear to be a meaningful investment of cash by the independent sponsor in the eyes of the lender. Now, there are exceptions to this rule because if an independent sponsor owns an existing business that has value and they're contributing the equity value of their existing asset to the deal, then the lender will say, okay, you don't have to put any cash equity because you're rolling in a lot of contributed equity value from the company that you already own. In that case, you don't have to put in cash, but that's really the only exception. But to answer your question, Jack, and it's a very good one, between 30 and 35%, of which half would be 15% or so would be about cash equity, and the 15 to 20% remaining would be seller note or seller residual equity.
Well, there you have it. Thank you for tuning in, and we look forward to seeing you next time in the Attract Capital webinar series.
Thanks, everybody.